and so we'll pop it up. So a great question to kind of kick off the back to basics. So reiterate Phyllis's question, is, someone buys a policy, maybe their foreign status going, home, and or they are here, maybe they're going on vacation and they pass away or something like that. What happens? So, it's so funny because I used to work as a wholesaler, for AIG. And when I used to work with a multi-level marketing group, that was a very common question, because a lot of people would go back to their home country and stay for 1, 2 months because it's a long flight, right? So in respect to that, what I would say is that I'll give you a good example. When I was a regional VP, we had a situation where a client, during COVID time, in the height of their home country, the big outbreak in COVID, and 70 plus year old parents, this 43-year-old went over to home country, nursed them back to health, made sure they were okay. Then, unfortunately, he caught COVID and actually passed away in their home country. So, they were on H-1Bs, wife, kids all went back and they stayed back in the home country. Well, um, I was asked to see if I could help because this is a big deal. So sent the death claim paperwork. All you need is the U.S. Embassy to certify the death claim and file the paperwork, and they can send the money anywhere in the world. The only thing they won't do is they won't transfer it to domestic currency. So wherever you are, as long as the policy is in force, that money is yours, or your beneficiaries, I should say, from the standpoint that the company will withhold the promise because it is a live contract, and as long as it's in force, it is covered. So, always been a big question, especially when people buy here, and they don't live here full time, or they moved here on a visa, debating on whether or not they're going to stay or move back. So that's a very, very good question, Phyllis. But yes, we have, in the insurance industry, paid death claims as people have gone over the seas and may have chosen not to come back, or whatever. The fishy one would be living benefits. If you look at pretty much all the carriers, for the most part, they simply say that you have to be reviewed on U.S. soil by a U.S. physician. There are some people who will bend that or flex that a little bit. And what I mean by that is, if, for example's sake, the person can't make it back, there's usually special exceptions that some carriers will offer or allow for those situations. But because you're outside, say say someone goes to Afghanistan for funsies, right? I don't know why, but fall, trip on a landmine, whatever, lose their arms and their legs, they can't perform 2 out of 6 activities of daily living. But it's hard for the insurance company from that standpoint to prove it, and things like that, because Photoshop can be doctored, and to take someone's word for it who's not US certified, that part gets a little hard. But the insurance companies aren't inhuman. I have seen claims for foreign living benefit claims, even when I was an RVP, but they do go through a special exception process, so it's not going to be in writing. So does that kind of answer your question? Were you looking more for the death benefit or living benefits or both?
It's it's perfect. That's exactly what I needed. You nailed it. Thanks a lot.
Yes, that's
Thank
what
you.
18 years of experience can do.
Yeah.
So no, I love it. I love it. So yeah, I mean, that's always interesting because I even brought up the topic on some of the Facebook groups just for fun, to say like, do people remember that, you can do IULs for death benefit focused as well as, accumulation focused. And a lot of people were just like, what? You can? And it's actually quite comical to say the least how certain organizations, certain ways that people like deliver the message on how these products are designed. It's only designed for one thing and one thing only, and that's not the case. The beauty of our industry is flexibility, fluidity, and choice. But I think at the end of the day, what a lot of people forget is that this is a hard industry. There's a reason why 90% of people fail within the first 2 years. And it's because they don't want to ask the hard questions. They're looking for the easy way out. And this is not an easy process. It's not an easy um, industry, to say the least. So, I always like to kind of hear, from you guys if you run into situations where maybe you're running into situations where clients may have seen something on TikTok, or Instagram about products. Have you guys come across any issues or situations where you had a rejection and you don't know how to overcome that? Just would love to kind of hear if anybody's running into stuff like that when they're talking to their clients.
So it's Phyllis again.
Long time no
Um,
talk.
I am yes, I'm new to the industry,
Yep.
and it's interesting how a lot of people have all these negative things about IULs.
Hmm.
It's like all they know is they are not good. But then
Yeah.
if you ask them why, they can provide the why.
Yep. Yep.
Uh, but then whole life too, we talk about whole life and it's expensive. It's okay.
Hmm.
So it's been kind of interesting, but that's where I'm trying to educate myself and um trying to educate myself that way I'm able to give them maybe a comparison like whole life versus IUL, what it can actually do for them, especially
Hmm.
like the retirement income option,
Hmm.
So um yeah, that's
So,
pretty much been like the difficult part so far.
so
It's
let
like
me ask a
everybody.
question. I'll play devil's advocate with you, or I'll ask you some questions. I see, obviously you're on the Zoom. Are you on your phone or are you on your laptop?
I'm actually on my phone. Um, and I have the three mark open.
Hmm.
That way, if Michael starts running illustrations, I can kind of follow him. So I'm on my phone right now.
Well, Lafayette, we won't be able to because you have to be appointed with them to run
Okay.
theirs. So, but that's okay. The reason why I was asking is when you think about it, you're on your phone. Your phone has a value to it, right? You didn't buy a flip phone. So when you have to look at when people are talking about these products or ideas, the idea is that you have to change the mindset of how people see things. A lot of people see it as a bill. And that's the hard part about our industry is we have to flip the concept to talk about it as an asset. So if positioned appropriately, which I always like underline, because people a lot of times in our
Okay.
industry don't position it appropriately. But if positioned appropriately, you have the greatest tool in your arsenal by using cash value based life insurance, whether death benefit focused or accumulation focused. So, talking about just the differences between them, like you can talk pros and cons. When I talk to people, I kind of tear up the process, not tear up, but tear up the process of the conversation. So, Phyllis, if you were my prospect, let's say, Phyllis, first and foremost, thank you for the opportunity to talk to you today. My goal is to make sure that you're protected during your working years, retire the way you deserve rather than the way the government tells you. And when you made too much, we got to find a way to protect that from Uncle Sam taking a piece of it for your legacy. So nowhere in there am I saying you need to buy a whole life or IUL yet. The next question would be are you more of a visual learner or do you mind just having a conversation?
Okay.
So most people will say, I'm more of a conversational person. If not, I always have a white pad ready or something like that. But, I would say, all right, think about your salary, your ultimate salary, what you have. Take that number and multiply it by 10, add your house, whatever you have left on your house, and then finally, you have any kids, add about 150,000 to that number, and that would be to help them go to college. So, what's your number? Most of the time, people are going to end up between 500,000 and a million, somewhere around there.
Mhm.
Okay. So, if I said to you, Phyllis, now you have an opportunity, that is a number to say that if you don't make it home tonight, your family will not struggle. Now, we can always tier change it, whatever we have to do, but just understand that, if you think the number should be lower, that means you're going to be picky choosy on some things to help protect your family, give them 10 times your income, pay off your mortgage, and help your kids go to college. So, from that standpoint, we can protect this in one of two ways. We can rent it or we could buy it. And from that standpoint, now you're thinking of exactly what they have. Are they apartment people or are they homeowners? What's the benefit of apartments? They're cheaper. You can live in them as long as you have a set duration of time, but once you stop paying the rent, you're out, right? But there's no equity that builds inside of that rental that is not your rental to own. So if you like the idea of growth, equity, accumulation, you would buy a house. Typically, when you buy a house, the mortgage is higher than the rent, but the benefits of it is you own it. It's something that you'll keep forever. And on top of that, it's going to grow equity inside of it. Which way do you want to visually see things? And so most people will want to see both. And then I simply say to them, all right, well, on this side, there's a vehicle that you can do to help you, depending on their income. So this is where it gets a little dicey. So some people will say, my income is $50,000 a year. Would I recommend a LIRP, life insurance retirement plan to them? No. Definitely not. We can do Roths with National Life Group. So you can do a Roth IRA. The cost of insurance for someone making $50,000 a year to put $100 a month or $50 a month into a LIRP will not look good, and it's not prudent for them in any way, shape, or form. So I would rather sell a term to protect the need and then do a Roth IRA to give them that tax favored growth or tax free growth. So we have to think ultimately of the people who fit in the right category. So as you're asking those questions about salary, growth, need, and benefit, then you should start to eliminate processes because you're asking them questions to get to the right answer.
Mhm.
Ultimately, what you're really doing is you're asking them questions to eliminate no's to get to an approval. So we go forward, and when we talk about the standpoint of next step is, we offer strategies where we can help you protect, what matters most to you is your family. But then ultimately, in the same token, our goal is to help you retire the way you want to. So if this person's a six-figure earner, and you can compare because if you see the threshold for 401ks is 23,500. Well, someone who makes 50,000 a year can put away almost 50% of their,
You can just cycle
total
there.
line
Who's
to
that?
they can put almost 50% into their 401k if they wanted to. Whereas someone who makes six figures can only put in, let's say it's 100,000, you can only put in about 23% of your take home. So, if you talk about justification and value as to why you should be looking at alternative options to help you retire the way you want to, rather than the way the government is going to tell you, how much would you put towards an asset like that to help you retire and give you some tax-free income to help support your retirement strategy? So, if it's three, four, 500, now we're speaking in the right lanes for certain people. And so if it's not, yeah, so if it's not in that lane, then a little supplemental permanent policy death benefit focus with some term to combo the two together, you can get a cost efficient price. The focus is still protection, but you'll have some cash value growth too, return to premium options and things like that as well. So, you just have to ask the questions to eliminate the client's concern. And then, from a budget standpoint, then you can figure out like we'll have Michael take the show for the whole life side and say, do you like something where you know you're going to get consistent returns? You know, you're never going to lose your money and, fit in the price point that you're asking. Or are you okay with taking a little bit of risk, having potentially higher upside, but you can also have, zero, comparatively speaking. And then now what you're doing is, and I learned this trick, it's we're not asking the client to to answer the hard questions. We're gonna have them answer the small questions, right? So the large question is they're buying insurance. We're already making that assumptive close. The question is, do you want something with, moderate returns, steady Eddie, or do you want something with ups and downs with potential higher or lower returns? And then the choice is up to them, but we're going to fit in their price point. So all these questions that you ask is meant to knock out
No.
no's and get you to the yes. So, does that help?
Absolutely. Thank you.
Oh, no problem. So what we'll do is, so Phyllis, we're going to take your question that you sent to me earlier. Michael, you ready to rock and roll with some Lafette?
I am.
All
I'm
right.
almost ready.
So
Um,
I'll give you the scenario. We got three kids, 4-year-old girl, 6-year-old boy, and 7-year-old girl. $300 a month for each of them, looking for cash value and want to see a 20 pay.
okay. How old was the last one?
Four girl, 6 boy, 7 girl.
7 girl. Okay.
Yep. So
So, and it's 20 pay. And you want me to illustrate a whole life?
Yes,
yep,
Okay.
because
yep.
we want to do something for them. Okay.
Mhm.
We're doing 529, but then we're not. Okay, so we want to do either IUL or whole life. I'm
Mhm.
leaning more towards whole life, but then the more I run IUL illustrations, it's becoming more appealing. So I'm kind of confused. So
Well,
Well,
I'll
yeah,
say this: don't fall for the BS illustrations. It's all
yeah,
manipulation. It literally is BS. So,
yeah,
so
um,
I don't know. Um,
yeah.
yeah.
The
Um,
idea, and I'll
go
let
ahead,
Michael
Phil.
take over in a sec. The idea that you always have to remember is you want to temper the expectation of the client. Unfortunately, you're going to have other agents who we'll pick on a VUL. Okay, so VUL is still out in the market, and if you're not working for a broker dealer like Edward Jones or Merrill Lynch, variable universal life is still illustrated around 10%, which is criminal. So the carriers are going to show illustrations for the people who don't know what they're doing to sell their product because they're higher up in the spreadsheet. So we as financial professionals have to temper the expectation and under promise and over deliver. So the idea of what after Michael finishes the whole lives, I'll do the flip side and do the IUL to kind of show you the right way you should be running IULs and some of the cleaner carriers that will give you a more honest return, comparatively speaking, and then pick and choose at that point. But there's pros and cons
I-
for both. So, but illustrations just prove ink sticks to paper. Unfortunately, that's it. So, um, so yeah. So Michael, why don't you dive in and give us a little sneak peek on Lafayette?
You want to use Lafayette?
Yeah, because again, from the structure and the process, so if people want
Okay.
to build teams around it, they can.
Okay.
If
Yeah.
you don't mind.
Okay. I'll use that.
Thanks, buddy.
Trying to share. Hold on.
You should have the screen.
Okay. Here we are.
Let's see the Google.
So I actually just had this question, and it's funny because right after I had this question, a client reached out to me yesterday, kid you not, within an hour, and it was the same exact scenario. But I had somebody say, "Hey, I want to run an IUL for my daughter. Um, and can you run an illustration for me?" And he's a licensed agent, he's a downline. But he goes, "Yeah." So I said, "What's your budget?" And he goes, "Like $100." And I was like, you don't want to do that." So um the reason being is you're not going to cover the expenses, right? Not enough
Yep.
money is going to the cash value. And so I told him, I said, look, at minimum, if you're going to consider an IUL, you should probably be looking close to $300 a month, right? And he goes, even for a minor? I said, yeah, even for a minor. Because remember, in the IUL, you cannot pay up an IUL. You can pay it for 20 years and use a vanishing premium, but it's not paid up, right? So it's still reliant on the growth of the policy to continue to pay the expenses. Whereas with a whole life, whether he wants to pay 10 years, 20 years, it can be truly paid up, money safe and sound, and continue to grow, right? And so with his budget, I said, well, you should probably at least start a whole life, right? Um, and there's a couple of riders on there I like, and Lafayette has the rider too. So there's a guaranteed insurability option rider. So when you set up your whole life, and Lafayette has it, I think every carrier pretty much has it, but it's essentially a rider that guarantees when they turn 26, they can take out another policy regardless of their insurability. And then an option date every 3 years. So 26, 29, 32, 35, 38, 41, 44, up to $1 million of coverage, right? So that's one of the big benefits I like with the whole life. So I like to include that on there. Now I will probably have to find that on here, Phil, because I don't typically run kids on here.
That's fine.
That's fine.
I
I'll just
I was
do.
gonna say we can just leave the GIR off it for right now.
Yeah.
Um, but yeah, it's what I would say is that most whole life carriers have the guaranteed issue insurability rider. Um, six one half dozen for the IULs. You can also use them when you have um, a change. So if pregnancy or marriage, you should be able to elect one in advance for that too.
I do forget which one's the 20 pay. I typically run the Patriot, which is a 30 pay. Uh, but for juvenile, I think the Heritage is a 20 pay.
Yeah, if you actually go back to the other screen, so go back to the Western Southern page. No, like the other tab, not in
Oh,
this.
okay.
Yeah, so if you go products and services and our products, it'll tell
Yeah,
you
I know
which
it's
one
here.
is which. Yeah,
Okay.
I think it's the
Yeah,
contender
20 years. Oh no.
heritage. No, I
Life
was
payable to
looking.
age 100 or
Yeah, you
whichever
got
is longer.
the contender was the one that Patriots the normal one.
This one here. Oh no, that's to 65.
Yeah,
Okay, so what we're gonna do is we're gonna do a reduced paid up. We'll use the Patriot. Back. So at 7 years old, you can do a little bit more base. I typically do a PUA blend. So let's say um, with Lafayette, if I do 50,000, I can exercise the maximum amount of that rider, right? So let's go ahead and do a monthly. Actually, we're doing 300, right?
Yeah.
So I'm going to put in 3,600. I'm going to do a PUA blend, right? So this is going to be, I'm going to use a 50-50 here.
And that's a level paid up addition for those who don't know, meaning you're putting half your money into the face amount, the base policy. I always say it's like cake. It's your base of the policy. It's like cake. And then the paid up additions is like icing you're putting on top of the cake. Of course, I have to correlate it to food.
Let's see. Option to purchase additional insurance. I would definitely include that with all kids policies because it's so cheap, and to have that guaranteed, it's worth it. Modified endowment contract.
Michael, when you put up the additional insurance rider, that was for them to be able to purchase that additional insurance, even regardless of insurability down the road.
Correct. Correct. Oops. So I'm gonna have to change this a little. I'm gonna do a 70-30. So when you have an adult, you can go all the way to like 10% base, 90% PUA. You can use a term rider to get more money into that policy, make it extremely liquid, right? For kids, you can't use the term rider. So you just have to have a little bit more base in there. So that's why we ran into mech issues at 50-50. Still running into it.
You want to run it on a Mass or someone else, you can. That's fine.
Okay.
If it's
Yeah, let me
easier for
run
you.
Mass. Or I can just run a base policy with Lafayette too.
Dealer's choice.
So my as a dealer, my choice is MassMutual. Reason why is because their waiver of premium, I actually found this out from a colleague. His dad had bought a MassMutual convertible term policy at age 40. At age 42, he got in an accident. Well, he had the waiver of premium rider on the policy. And when he was telling me this story, in my head, I'm thinking, oh, cool, they paid the premium for the term policy, right? No, they converted the policy, $500,000 for a 42-year-old male, and they paid the full premiums all the way. He's 64. He turns 65 next year. They're paying it up to 65. He has a retirement because he had that waiver of premium on a convertible term because it still earns all the cash value, all the dividends. And so what that did was it caused me to actually make a phone call and say, hey, I need to understand, was this like a one-off thing or is this a standard practice, right? Did you guys just take care of this guy and convert it for him, or do you guys automatically always convert? Well, they said it's standard practice. If they're permanently disabled, you can convert the term policy to a whole life policy. They'll pay the full premium,
You
still
continue
earn
to
all the
pay.
guaranteed interest and dividends,
Yep.
which is I thought was insane. Our internal, well, Riley Henry, I don't know what his position is, but he's the one I usually deal with MassMutual. He went a step further and told me, by the way, on the children's policies, if you add the guaranteed insurability option rider and the waiver of premium, not only does it cover the initial policy, it covers all 8 optional policies. So that's up to $1 million of coverage that they would cover fully. Talk about insuring a retirement. That's pretty crazy, right? So,
Yeah, I always like, in my opinion, because again, manner of opinion, I've found the insurability, like the waiver of premium to be almost like pointless, but you always hear these one-off stories here or there to like make you say, oh, maybe I should do that, You just never know. Obviously, that's why it's insurance, right? But you just never know.
what I typically do is I try to find the fine line, giving them access to cash and not making, right? So, what I will do first is I'm going to run I'm going to run 100,000, see what that price is real quick.
Another lesson here, save your name in the WinFlex.
Yeah. The only thing it doesn't keep in there is the license number. I have to push a little button,
I
but
just do 1, 2, 3, 4, 5.
okay.
Just
So I
saying.
can see already this is less than $100. So we're going to need to bump this up to get to $300, because that's not going to be enough coverage to prevent a mech if we add PUAs. So let me run 250 for the base. So we're close to 300 here. Let me see what cash value we have. So sometimes like the 10 pays, they're already built in where you're overfunding the policy. So that's why like on a 10 pay, you can't really stick a lot of extra money on top of that because it's already designed for cash value, right?
Yeah. Yeah.
So this one we have a little bit here. So I'm going to leave it at 250 and then we're just going to dump the leftover into PUA. So we need an extra, what, $400? Let's do 360. I didn't even count the riders. So there's the option 125.
Michael, can you please explain what the 360 is for?
So I'm adding additional money on top of what the base policy is. So when you run an IUL, you overfund the IUL, right? Or you max fund. You can put more money in. You can do the same thing with whole life. The difference is it doesn't just go to the cash value. It also goes, or it purchases paid up addition. So it's still liquid, but you're going to see the death benefit of a whole life increase faster than a death benefit of an IUL in most cases.
Michael, I think I found an easier way to do it.
What's that?
Mind if I take the rock for a second?
No, not at all.
All right.
I think there's a solve, but yeah.
Yeah, here we go. All right. So with this, we're going to simplify the process. So 7-year-old female, non-tobacco design. So if you do the design base plus the LISR, Total face amount, just solve. It's going to stay at solve. And
Okay,
then you
you're
put
gonna
your
have to break
basic.
that screen up a little bit more because that's too tiny.
Some old eyes, I see. Some old eyes.
Exactly.
All right. LISR is basically like adding in some additional, coverage over the top. So, um, basically, we're trying to find the least amount of face amount. So, solve assumes a 50-50 blend, 1-to-1 ratio base plus LISR. So I just did 100,000 just to start, but the premium's 300 per month, 20 pay. You know, nothing else at this point, but gosh, crap. Now I gotta re-illustrate it. So it's just figuring out. I went with a small face amount, but because they're a kid, it's still gonna be higher from that standpoint. But we're looking at a 50-50 blend here from that standpoint. And yeah, 200K face, 3,600. Open it up. So they're pretty solid cash right off the bat. Um, Crap, I was wrong. I tried. Damn it. I looked at the first one. I'm like, yes, I got this.
Okay,
After
go down to the actual illustration, the
the
page that
real
breaks down the
ledger.
payment
Yep.
right there. Oh, too far.
Up or down?
It's like the second page of the illustration, page
Okay.
2, right there. So yeah, they did let you put money in the lister. Okay.
Yep. So it's gonna
So
blend it. You just got to find
so
the
the
right
money,
number.
yeah, the you want to put money into the Ailer though.
Taylor.
So the Ailer is the true paid up edition. The lister is a decreasing term. So
Gotcha.
if you,
Okay.
yeah, yeah,
So that's what this is all set up to be. So if we did, I don't know. Well, the base face amount here is 205 for 100,000. Or base face is $100 a month. So we should be able to put more than that into the other setup, right?
yeah,
So if we
yeah. What
did
I'm gonna do is, so let me take over again.
yep,
I wasn't
yep,
sure if it was gonna let us do the lister because they're a kid. I typically don't because most carriers don't let you do the term rider.
yep,
So I usually on a kid's policy, it's base and Ailer, and that's it. When I, but I'll run it this way.
sure.
By the way, this is how I do it for any adult. You're gonna have the term rider on there. What I'm gonna do is I'm gonna select how much. Um, so yeah, you can solve this number, and you can
Ah,
solve the base, and then you pick. Okay, out of that, my premium is gonna be. Let's say I want. Let's say I want 100 going to base. I'm gonna do 125. So now that's 125 going here. And what we're going to do is we're going to put 175 over here
20 years.
for 20. So
So again, for those who have never really done this before, what Michael's doing is he's putting icing on top of the cake. Okay. So you always have to pay the base premium for the policy, but on the flip side is that that's going to stay rigid, and that's going to pay. So 125 is going to pay for a base policy. So let's say it's going to be like $125,000. But then $175 might buy 25,000 in pay up additions. Something like that. A much smaller number because you're trying to drive more towards paid up policies or icing on top of the cake to build up. It's already paid up and it's going to drive cash growth as well. So that's why there's a lot of hunting and
that
pecking with
makes
whole
sense.
life. You got,
About 2000.
yeah, you had to go longer, but that's all right. You got the gist of it right here. The base
So you
premium
can,
plus the
this
other.
is the breakdown, right? The base, look, the lister only costs 126. This breaks down the uh, coverage. So they do half and half on the base, half on the lister. You can manipulate it to put more onto the lister if you want a higher liquidity or more liquidity in the policy. And then this is the AILR for that first year because we're putting $175 a month into that AILR, which is a paid up additions rider. We included the guaranteed insurability rider, so they have those options for eight policies, 125,000 each, and they have the waiver of premium. So if anything happens, this policy and those other 8 policies would be potentially paid in full, right?
So for those who, as you're getting to the money page, for those who don't know, the lister just keeps the cost down, blending in some term. So it keeps the cost more cost efficient on an expensive product to allow you to get more going towards cash, which you see here. Basically, if you scroll up just a little bit, Michael, you see the non-guaranteed values and the guaranteed, there's a line in between. The only difference between those is the annual dividend. So the dividend is not guaranteed, but never missed. So yeah, so if you want to
It's the
explain
best
this.
bet for a non-guaranteed I've ever seen.
Exactly. Yep. Yep.
By the way, it doesn't matter what company you're running. MassMutual, New York Life, Northwestern, Guardian, Lafayette, One America. Like these companies have all been around over 100 years and none of them have missed dividends.
Ever.
Like it's a crazy track record, right? And so when you look at the non-guaranteed, it's the best non-guaranteed bet I've ever seen, right? But because they do fluctuate, meaning the dividend might be higher one year or lower the next year, they can't guarantee this is going to be your cash value, right? They can only guarantee the guaranteed interest over here. So what you see in the first year, you have $2,000 available. By the way, your death benefit is $200,000. And so the second year, you see a nice increase right here. It's very predictable. Even on a guaranteed basis, you're going to see a good increase. I want you to pay attention to the dividend or sorry, to the death benefit. Remember, this extra money is buying additional insurance. The dividends are also going into the AILR or paid up additions. So even though you're only putting in $35.94, you're adding $15,000 to the death benefit that year, right? By year 2, it's already $231. So there's a couple reasons I like the whole life. Number one, very predictable. So if clients want to use this money and borrow against it, they can be more aggressive with the loans. I had a client take 90% of his cash value out a year ago. That's still a little higher than I'd like, but he can do so because even though there's a loan cost, he predictably knows, okay, but I'm paying, I'm also paying my premiums, and I also know I got this guaranteed interest and a dividend to help offset that. Now, people think of infinite banking. If you ever heard that term, people sell it on YouTube or not on YouTube, but like TikTok, the TikTok advisors, right? They sell it as positive arbitrage, right? Infinite banking is not positive arbitrage. What the loans and the dividends are designed to do is really to offset each other, right? So if you guys don't know, dividends follow the bond market, right? Interest rates go up, dividends go up. Interest rates go down, dividends go down, but they're slow. So the loans also follow the same rates. So as the market's going down, you might get a low, let's say you get a low loan rate, but the dividends are still chasing, they're trailing. So because the dividends are still higher, you're going to get a positive arbitrage in those years. But if you have a long enough time frame where the rates are going up, right, they're going to charge you the higher rate, and the dividend rates are what they're following. So you might have like a negative arbitrage. But overall, they're typically going to balance each other out. And like I said, it's not like an IUL where you have to be a little bit more conservative with the loans because you don't want to take 90% out and then you get 2 zeros back to back and your policy lapse, right? With this, we know we're getting money to offset those loans. So We can be a little bit more aggressive. That's why it's ideal for infinite banking. Also, the guarantees. And then when you consider the Rockefeller strategy, what is the strategy? They want to use their money, right? They want to use the money, but they want the death benefit to replenish the trust. So if you look at, I'll skip forward to like 70. So if you look at the cash value at age 70, they want to use this 1.4 million. But look at this death benefit. They're going to replenish the trust with $800,000 above and beyond that. You cannot use an IUL for the Rockefeller strategy because what do you have to do when you have vanishing premiums in an IUL? You got to close the corridor so the cost of insurance doesn't get out of hand, right? Well, what does that mean? You're mostly self-insured. So if you use that money, there's not a large death benefit on the other side of that, right? With IUL, you have to kind of pick cash value or death benefit. And you do the same thing with whole life, but it really provides both a lot better, right? And on a guaranteed basis. The other reason, so this one did not pay up.
You
I thought,
I know why. Because
I thought I chose the 20 pay.
you did, but you added when you start doing the calendar. So let's just focus on the 20 year though. So what I'll do is because we're getting closer to time. Um, if you got the 20 year here, you paid basically so 35,000, $70,000. You have about 95,807 in cash. Is that or 121? Which one is it?
No, that's the paid up
Cash.
edition,
Yeah, so cash is 95,807.
right?
Um, so what
With
I'll do is go ahead.
Yeah, with a $500,000 death benefit too. So here's the thing with whole life. Now you can select a 10 pay, you can select a 20 pay, but the reality is you can pay this up at any time.
Good.
So even if you ran an illustration like this and the client said, hey, after 20 years, you know what? I don't want to pay any more into this policy. What you would do is you'd make a phone call to the insurance carrier and you would say, hey, I don't want any more premium. I don't want to pay any more premiums. I want to reduce paid up.
Mhm.
They will reduce the coverage based on what you've put in. And then, so the death benefit would decrease, but your money here or here would be safe and sound, meaning it's not reliant on if I earn interest, I don't have any additional costs like I would with an IUL, right?
Mhm.
If I don't have enough money in there and it doesn't perform, an IUL will eat up the cash value if you're not paying premiums because you still got to pay the cost of insurance. You still got to pay some fees, right? With a whole
Well,
life,
good.
go ahead. But with a whole life, you're still going to earn the guaranteed interest and the dividends. So this money will increase year after year on a guaranteed basis, even after you stop making premiums. Now, I think Phil was probably going to mention there are still some costs when you see the dividends, like MassMutual is boasting a 6.3% dividend. You still have to take about 50 basis points out because there is cost that comes out of there. So it's not a net dividend, it's a gross dividend.
Well, I was
But
going to
even
say
so, yeah, go ahead.
on the guaranteed side, because you have the paid up additions rider, if you call up the company in year 20, you are guaranteed no less than 333,225. So that is fully guaranteed because you put more into the paid up additions rider, which supplements and builds on top of the policy. So that is tried and true what you have right there.
Yeah. So what I teach people is I say, let's start with the foundation. Let's start with whole life. By the way, I've had one client, I've had two clients lose money through their IUL, but one client in particular, she was making her premiums. It was actually set up well. So she wasn't disappointed when she canceled her policy, but she was 3 years in. She got herself in financial trouble. She's like, I just can't make the premiums no more. And I said, well, we got to cancel the policy because if you leave it, you're going to be paying for this policy, right? So that cash value will get used towards the cost of insurance. And I wish I had her in a whole life because I could have called the carrier and said, hey, let's do reduced paid up. I want this cash value to continue to grow, right? And we just want it protected. But what we did was we took the surrender charge because that's the other thing, it was under a surrender. So she did lose money in this policy. Luckily enough, I had it set up where enough of that was going to the cash value that she wasn't really mad about it, but I was kind of mad about it. Just being a professional, right? So, uh, but yeah, unfortunately, because she could not continue, the best solution was to cancel the policy because if we just left the money in there, it would be eaten up by the cost of insurance over time. Whereas with a whole life, we could have protected that money using a reduced paid up. So I like to start there. If you want to do an IUL after that, great. But I want something where, hey, this is our base. I always look at commitment levels, like what are you able to commit to in terms of premium, versus what do you want to put in as far as your premium, and we can create flexibility with that. But that's typically what I use.
So let's go through the flip side. So I'm gonna steal back the screen and I'm gonna use, God, where did it go? Sorry, not my kids. So I ran Columbus just because I don't want to be biased and just always throw AIG out there for everybody. But I'll show you how I ran this. This is like the cooking show. Um, I already have the illustration done, but I want to show you how I made the cake, right? Again with the cake. So what we have here is a 7-year-old female juvie, tobacco abstainer. They say abstainer, non-tobacco. So solve for the way they do it in WinFlex is different. Matter of fact, let me just actually go through. I was doing it anew. So the Index Explorer Plus 2025. The reason why I'm picking Columbus is they only have the S&P. They have strong rate integrity, and they have a very solid IUL from the standpoint of full transparency. So, like what Michael was saying with
Can
the,
I add a few things?
yeah, go ahead.
Because I do love Columbus,
Yep.
especially compared to other IULs. Um, they also have the strongest rating, financial rating, a 96 on the Comdex score. And when you're talking about cash value life insurance, remember your performance is based on that company's success. So more important than what numbers show up on an illustration are the financial ratings of a company,
Yep.
right? That's what's going to keep those cap rates up long term. There's a couple other things I like about Columbus. So as you look later down the road, their per thousand charge is guaranteed at maximum 20 years, whereas most of the other companies, they can charge that if they needed to the rest of your life, right? Which if your client got stuck with that kind of charge the rest of their life, that would significantly affect the performance versus the illustration, right? Just like the cap rates would as well. So when you look at that, and then you also look at the fact, so I can guarantee my client's not going to have this extra charge in retirement. The other thing is their persistency bonus is also guaranteed. It's 50 basis points. So as you close that corridor, right, and you still have a cost of insurance, because remember you cannot pay up the IUL, but if I have a guaranteed 50 basis points helping to cover that cost, that really helps offset and allow my policy to continue to grow. So contractually as well, it's a very good policy compared to most other policies.
And from the producer side, the better they do, the better you do too, because they have trails on their cash value. So as the IUL grows, the cash value grows. Starting in year 2 and beyond, the more policies you sell, the higher trail you'll get even on cash value. So they actually pay you to take care of your client. It's crazy, why that's such a weird thing in our system, or, It should be the way it is, but because there's such heap comp with insurance companies, they just won't, think outside the box with that. So Columbus has taken a nice stand with that. They're the only carrier I know that really pays trails on cash value on the IUL side. I know, there's renewals and stuff on with like Northwestern and stuff like that, New York Life, but here it starts out at no solve. We're going to keep it at no solve. And face amount, we just want to change that to minimum. So minimum, no mech. And all we're going to do is just double click here and change it to 300, which was the 300 per month. Click on the calendar. And 1 to 20 is the time frame that we want to put 300 bucks a month in. I'm going to double click here and just put 0. Everything else you can kind of keep the same. Policy options, we are going to do increasing for the first 20 years because that's the time frame we're funding. And the idea there is you want to keep a lower death benefit to start and then have it grow from there. And we just want to change it to monthly. Other than that, the interest rate, I'm okay with 668 because it's with the S&P. The S&P they have right now is around 11%, and the average return of the S&P over the last 30 years has been around 10%. However, again, we're not looking at the yearly average because I could have a policy today that got 0% because the point to point went down, but Gloria might have a policy a day later that might be a 10% return because of the timing of the point to point. So, stuff like that, just conversationally speaking, to be aware of. But let's just say we put 100% in the annual point to point. No riders, just keep it plain vanilla. Um, and just kind of, do it quick and dirty. They do have an enhanced cash value rider, so that could give you up to, 80 to 90% cash value from day one or in the first year. They're the only carrier that can give you an early cash value rider without a 5-year payout for your commission. Your policy just has to be in force for 5 years. So there is a drag on cash value in the later years, but if someone needs early cash value for premium finance, or for, other reasons, you can add it on, I'm not going to do term riders, just keep it plain vanilla. If I hit calculate, what would show up is this little guy. So, or little gal, because it's a 7-year-old girl. We're looking initially at 162,109 in face amount. So comparatively speaking, the MassMutual policy with the term rider blend and everything else had a higher face amount, paid up additions, so on and so forth. Right-hand column, 6.68% rate of return. As you can see all the way down the line. Crossover period here is not in the first 10 years, which it was also the same with the MassMutual policy. So it was really year 11 where you started to cross over from what you put into the policy to, your account value. If you'll notice here too, they are a 10-year surrender schedule company, not a 15 or 20-year like some other companies. So you'll see right there, you have full liquidity or accessibility at year 11. And then you'll see by year 20, 72,000 in premium with an average 20-year rate of return 6.68, you have 114,053. MassMutual policy had a much higher face amount, 400,000 plus, and a cash value around 95,000. Once again, the big thing, because I know we're already past the hour, is when you put a bow on this, you can show the clients both and let them pick. Either way, you win, right? So if there's a value proposition for, hey, you could get higher potential cash, here's the opportunity, but we have to manage it year to year to make sure everything is going the way it should, or if we have to make adjustments. The other one is more set it and forget it. And it's kind of have your cake and eat it too. You have some cash growth, you have some death benefit. So does the client want a higher death benefit with sacrificing a little bit of cash? Toss up. But the big thing is, and I'll kind of open it up for questions after this as well, is when you look at the differences and when you understand the differences is we don't have to pick. Okay? Liability is liability is liability. Our job is to provide scenarios and options for the client to make an educated decision. If they say, "Well, what do you think?" I'd say, "Well, it really just depends. Do you want a little bit more risk for potentially a higher return, or do you want something that you know is a consistent premium, consistent cost, and go from there?" So there's benefits to both sides. But a lot of people in this industry, whatever flag you plant or wherever you hang your hat, will either have a bias to one and hate the other, but you don't have to feel that way. If you give the clients the option, it gives them the feeling that they're making the purchase power. So it's a little bit of a psychology thing. But two, CYA, right? The biggest thing in our industry is cover your because there's a lot of people, yeah, thank you, Gloria. There's a lot of people who are trigger happy to say, this person told me this, they didn't do this, I want to sue them, or I want all my money back. Well, you can't because of the contracts and this and that. But you'd be amazed at how many insurance commissioners want to sue an insurance company. A lot of money in doing that. So that's why these are 60-page illustrations. It's not because people love reading 60 pages worth of stuff. It's because they have to have legality and information in there to cover their keister. So if you have A versus B, you're going to pick one of the two options, whole life or IUL, doesn't matter. Or if you did it the old school way and you're like whole life or nothing or IUL or nothing, well, you have a 50-50 shot at missing the business completely. So the idea still stands that flexibility and option, the independent side has that value proposition, but you as independent people can think for yourself. There's no bad policies, just bad agents. So, so we started. Go ahead,
I
Michael.
was gonna say, Phil, that was something when I before I got on my computer when you were talking about agents didn't even know they could use an insurance policy as insurance. Go figure,
I know, right?
right? But
Whoa.
yeah, like crazy, right? But
Yeah.
one thing I will say when you look at the numbers, that's why I said both um neither illustration is guaranteed. So just understand that, right? Um, but if I'm gonna make a bet between, okay, I have 95,000 in my whole life or an illustrated 114, the one thing I know about IUL is, and it pains me. So Columbus made this change a year ago. They had one of the greatest stories of IUL. One of their stories was, hey, we've never changed our rates on our older block of business.
Mhm.
And what does that mean? It means they can block the business. So policies that were issued prior to 2022 have a different rate than policies that were issued after 22 or new business, right? So the new business illustrates the current assumption, which I believe is a 10.75% cap right now. But the older block of business actually has a 9.75. So understand that you will have a cap reduction most likely. So when you look at this number here, is why I say like I prefer the whole life because okay, I don't think I'll actually get 114 because I know I'm going to have that reduction, even if it's just 1%, right? But 1% of 100,000 is $1,000. So I could be missing quite a few $1,000s here. But again, with my whole life, I can pay that up. I can access that money. With this, I have to account for, hey, I'm still going to have insurance charges if I stop paying. So I have to be careful how I access my money. And so for me, it's like, how do I have access to my capital? Can I borrow? Can I borrow from it comfortably, or do I have to be a little bit more conservative, right? So that's why I personally prefer whole life. But yeah, if you're using this long term, you do have a shot to outperform the whole life with an IUL over the years. So yeah,
So
you
Phyllis,
can go either way.
yeah, I was gonna say, Phyllis, does that answer your question? I know we spent an hour.
Absolutely. Yeah,
Yeah.
it's been
Okay.
very helpful. Thank you,
Cool.
guys.
No problem. Did you get clarity on how to run them too, or still need help with that, or?
The
I know
whole
we
life
kind
one was a little bit fast, but I'm sure one of the classes,
well,
can go over. But
if you ever want to look at it again, it will be up on the YouTube channel. See how I did that? Marketing,
uh-huh.
baby. So we'll have the back to basics up tomorrow. So if you want to
Okay,
watch the replay, it'll all
definitely
be up
will.
there. Yeah.
Okay,
So
thanks, guys.
no problem. Anyone have any other questions as we kind of wrap up for the evening? Nothing? Gloria, was this good for you? Was it good for you?
Yeah, this was really good because I'm starting to reach out to my clients and start rewriting some stuff,
Yeah.
bringing it this
Oh,
way.
efficiently and appropriately, of course, right?
Doing it correctly, exactly.
Yeah.
Doing it
Yeah.
correctly. Not the people helping Patrick way.
Exactly. How about you, Jay? I saw you went off mute for a second and I saw some clappy hands.
No,
So,
all good. I mean, I'm learning new things here. Whole life
yeah.
IUL. I'm mostly an IUL guy, so I'm learning slowly on whole life.
Yeah. It's not the devil. It's just, different people have different ways of selling tactics, to try and get you to sell their products. So once again, if you think about it, Priorg planted their flag with IUL in terms. So, New York Life is the devil. That's your biggest competitor. Well, you can sell New York Life if you want to. So, um, but yeah, that's that's the big thing. So, I'll kind of put a bow on this again. This will be up on the YouTube channel tomorrow. Folks, if you have time tomorrow, 4 o'clock Central, we are going to have Annuity Genius on to kind of show you the whole new world of how you can run your annuities. Um, I'll give you a quick synopsis. We had a case with some of our teammates or partners where the client was already getting income from Global Atlantic. And we reassessed, we reviewed it, and found another carrier, National Western Life. Who ever heard of them? A-rated carrier, mutual company. Yep. So with that, we were able to move $1 million from Global to National Western, increase their payout, as a customer, and put some pocket change in the agent who wasn't working with us at the time now is. So when you talk about some of the cool stuff that we have, it is not free. So, but you want to see the value in it. It already paid for itself for me for the next like 10 years with that. So, needless to say, definitely worth seeing, the value proposition, what they bring to the table. That is at 4 o'clock Central tomorrow. If you do not have that information, it's in the newsletter that I send out that you guys probably just delete anyway. And I'm
Oh,
kidding. I'm kidding. I know you read it, Gloria, because I can see who reads it. I can see all the statistics. I'm looking at you, Garcia. Just kidding. Um, anyway, you guys have a great rest of your night. I appreciate the loyal crew here. If you feel anybody else should or could find value in this, the big thing is this is open for anybody. So feel free to invite people, pass along the registration. The more the merrier. The whole goal is to help your community. And when you help your community, the community helps you. So have a great rest of your night. Thank you guys. And we'll see you tomorrow.
bye, Phil. Thank you,
Yeah.
Michael.
Bye, guys.
Thank you,
Bye,
Phil.
Phil.
Bye.
Bye.